Thank you. Appreciate the opportunity to visit with individuals from the FDIC. Most of my time in the Senate, which is short, certainly in the Banking Committee, we've raised the topic of regulations of community banks. And I've raised that not just with the FDIC, but other regulators. There's a pretty standard response to those questions about how we understand the value of community banks. We treat them differently. We have an advisory committee that we get input from. And yet the statistics and trends continue with additional consolidation. I see it in the numbers in Kansas. The number of banks is less than it was a year ago. And I hear it anecdotally, the continual conversation, and it makes sense to me that the increasing cost of regulation means that a bank has to be larger in order to cover the costs of those regulations. Fixed costs matter. I remember a banker telling me that an examiner was in the bank and suggested that they hire 2 more people in the bank to comply with rules and regulations. The bank employs 8 people. 2 people is a significant increase in the number of people working there. Increasing employment would be a good thing, but not if you can't afford to do that. And so our bankers' options, particularly as the economy becomes more difficult, their options generally are to find some other bank interested in buying them. And I think there's a significant consequence to rural America in the absence of community financial institutions. The ability the relationship banking remains important to my farmers, ranchers, small businessmen and women. And my concern or complaint is that I don't want to be pejorative and say we continue to provide lip service to this issue, but I can't ever find any evidence that we're really doing anything differently in regard to the regulatory environment that community financial institutions face. And maybe you could satisfy me with the suggestion that we have a different examining standard, we have different criteria when our examiners are in the bank, we have a different set, we have eliminated, give me an example of regulations that we've eliminated or modified because of the size and scope of the bank. And again, I would portray this, at least in my view, that all of this is in the context of financial institutions that are not too big to fail and that have little consequence, significant consequence in a community or to shareholders, but little consequence systemically to the economy. Can you assure me that the conversations that I've had with individuals who regulate banks and are responsible for those regulations over the last 2.5 years have done more than tell me they understand my problem and have done something about it?
Senator, your question on consolidation is a very good one, and I do want to put it in perspective that after
my other questions are not.
They're all very useful. After 2.5 decades of consolidation that we followed in our study, 95% of banking organizations in 2011 were community banks, and we saw the biggest decline among very small community banks. The number under 25 million actually declined by 96%. Much less consolidation at slightly larger size groups. In fact, the number of charters with assets between $100 million and $1 billion increased by 19% over the study period, and that's where 65% of community banks currently operate. We did studies of economies of scale. How much do average costs fall as asset size increases? For some lines of business, like commercial real estate lending, there were some economies of scale, but most of them were realized at an asset size of $100 to $300 million. So the idea that you have to be a $2 or $3 billion bank to do business, I'm not sure that the numbers square up with that. That said, we also understand that the overhead expenses of community banks are very sensitive to regulatory costs and staffing for regulatory purposes. The FDIC has undertaken a number of steps, you described them, to try to mitigate those costs, provide services that are valuable to the banks in terms of meeting those regulatory requirements.
That answer is different than the other answers I've received over the last 2.5 years. What are the specific examples of modifications that the FDIC has made to accommodate? And I guess let me further indicate to you that I understand if this was a matter of bank consolidation because of normal free market economic principles about size of scale, economies, that to me is a different issue for us than one that is driven by the regulatory environment and the fixed costs or the costs associated with meeting those requirements. I don't know whether your study demonstrates is there an explanation for why those costs increase and the economies of scale? And I guess to further indicate that a $25 million bank is important to me and to a community in Kansas, and when you assure me that things get better at 100 million and above, I mean, I'm pleased to know that, but there are a lot of banks in Kansas that fall between that 25 million and that 100 million that are very important, certainly to the people who work there, who own that bank, but more importantly to the community that they serve.
Well, understood. And I think those economies of scale that I referred to, the decline in average cost, includes both regulatory and non-regulatory costs. The fact is we don't have the data to break down overhead expenses between those two categories, so we can only look at overall overhead costs. But for the community banking sector, the last 3 years, those overhead costs as a percent of assets have been stable at 2.9% of average assets. And so we're not seeing large increases in overall overhead expenses. We do understand, though, the need to, the opportunity for technical assistance on the part of the FDIC. We've created a web-based pre-exam tool to make sure that information requests are synchronized and very clear with the bank being examined. We've created a regulatory calendar that reminds institutions of when the comment periods and the compliance periods are. And we've created a series of videos on our Directors Resource Center that provide very detailed technical information about how to comply with the various standards coming down the pike, so consultants are not needed to explain that. So we think those can be helpful in terms of helping them navigate.
Thank you very much. My time has expired. I would only point out that what the FDIC does is critical in this arena. You are at least one of the few, if not the one regulator that the bank can't escape. As we've seen in our state and elsewhere in the country, as banks have rechartered to become state institutions to alter this regulatory environment, they're never going to get away from you. And what you do matters to the success not just of my banks, but to the communities that they serve. Thank you.